All right, this is Jeff Scott. It's October 11th, 2014. I'm in my live meeting in Palm Beach, and I'm going to be recording this section for placement and YouTube for my weekend review, which I said I wasn't going to do today. As always, the disclaimer is for educational purposes only. Anything I give should not be considered investment advice, but should be considered education. I'm a doctor, not a broker, and I'm independent. As always, you know I like to look at my bell-shaped curve. I've been concerned about being in that red circle. I think we've dropped down, and we're clearly entering stage 4. I hope to prove that to you today. And one thing that I haven't shown in a long time, it's easy in an uptrend. You buy pullbacks, but in reality, as long as you weren't the last person buying, you probably made money. In a downtrend, I don't know where to go long. This is it right here. I guess you buy the retracement. I short the retracement. I don't buy them. We are clearly, I believe, heading into a downtrend. And, Darvis box, you sell resistance and buy support. So I think a time in the market for caution is here. Real quickly, I want to look at the smart money commitment of traders report in TradeStation, and then I want to jump in and get rolling. All right. So many of you know that I follow John Person. This is from his indicator set. You can see Person here all over the place. And so what he's done is he's created a settings indicator that tracks the commitment of traders report. In yellow are individual investors like us. In blue are professionals like the hedge funds and the banks. And in red are professional hedgers. They're not necessarily predicting the direction of the market. Rather, they're hedging current positions, whether it's in livestock, feeder cattle, metals, liquids, or index futures. So they're interesting, but that's not what I follow. What I look at is the relationship to the yellows and blues. So a couple of things. If we look at where the market came down in 2008 and 2009, we could see that this is failing at the 50-day moving average, I believe, or 50 weekly moving average. You could see in yellow that the entire way down, the individual investors, were buying, while the professional investors were short S&P futures. Right before the bottom, we switched to short, and the professionals in the darker blue went long. And it took us until a year later before the individual investors actually went long, which of course is when the market sold off again. So we usually are wrong, and the professional investors are right. So if I look at where we are right now, we are long. The professional investors have been short going back for most of this year. And over the last couple of weeks, although it's just a little bit, there's a little blue bars here, the professionals have gotten long. So that might make me feel good, but it does remind me that they also went long a little bit before the bottom in 2009. So that's not enough to make me feel that we're out of the woods. It's interesting and something that I'm going to continue to watch. So less PowerPoint today and more presentation. So here's open so I can make sure I go through the right things. And then you just follow along. So the first thing that I always do on my weekend report is to do a group performance analysis and get an idea of what's working and what's not working in the market. And I actually did one already. So I think I've got, let me see if I got that in the charts here. So this is the group performance analysis that I did for this week. And what you could see is it ran from October 3rd to October 10th. In live, we've already done it, so I'm not going to repeat it live. And you could see that in this period of time, only one group was positive, and that was because they had one home run 8 out of 9 were losers, but the winner was up so big the group was up 2.45%. Other than that, every group that I track on the bullish groups was negative on the week. That includes the IBD 50 was down 7%. The HGS 100 was down 5.33%. Even the Market Smith Growth Group was down 5.11%. If you trade long, actually, I'm going to do it. I'll show you how to do it live very quickly. This was a tough week to make money. The way you do the group performance analysis is you go into HGSI, and I'm just going to do a very quick one. You go into the designer, you do tools, and you go group performance analysis. You then choose the groups, and for the sake of this one, I'm just going to look at the indexes. I hit OK, and I want to look at from end of market last week, which has been on the 3rd, closing price on the 3rd to closing price on the 10th, and I'm going to hit OK, and it's going to show me the group inclusion report, or the group performance analysis. And it basically shows me that over the last 7 or 5 trading days, you can see semiconductors down 9.9%, transports down 6.94%. Who would think oil down 4.5%, 4.6%, and transports getting killed at the same time? The only things that were up were volatility, gold, silver, up nominal, T-bonds, treasury bonds, and utilities. So it just gives you an idea of how weak this market was. All right. So when I do my top-down review, I use a number of different tools. I'm going to go backwards today and start with HGSI. So I go into Woodward and Brown user groups, major market groups, and then I go into Major Markets Plus, and I do a warehouse view of that. All right, there we go. And I like to use my T1 view because it's purely technical, and it's got weightings out a couple of weeks, but it's heavily weighted towards 1 day and 5 day. I sort by raw combo, and I see that the overperformers are the T-bonds and utilities, and dollar are up at the top in volatility. And on the bottom are mid caps, small caps, the NASDAQ and the NYSE and semiconductors. You're not making money to the long side, whether you're a growth stock investor or a value stock, if you have this type of a picture. This was a very difficult week. If we look at 5-day performance, we see volatility was up 46%. Imagine if you owned a 3x or a 2x volatility ETF. VXX, TVIX, and others. They were a great week. Silver and gold were up 5 days about 2.5 to 3%. Semiconductors down 9.9, transports down 6.9, Russell down 4.7, NASDAQ down 4.5, mid-caps down 4.4. This was a very difficult week in the market. I'm going to jump into a different presentation that I gave earlier today that I think gives you an idea of how bad this market is. And I think it's worth showing. Oh, looking for one slide. Here it is. So here's a slide that I did for my meeting. This is from Fred Richards' website where I cut and pasted, just showing you year to date. You can see the Russell's down now 9.5%. S&P 600 is down 8.2%. NASDAQ 100 is the big leader, up 7.8%. This are the industries on a 30-minute or 10-minute chart at the end of the day. On Friday, you could see the nice place to go skiing from, not a nice place to be going long from, which has me worried. We closed at the lows. And the last thing I want to show you is these are the indexes, the dates of the last high. The Russell's peak was actually in July, it had a lower high in September. You could see how much off the highs they are, and you could see we've really had a bigger correction here than we've had in some time. And you look at, for example, the NASDAQ is down 7.25% in 15 trading days. That should give you an idea of how painful this market is. So I don't think there's any question from the initial analysis that this chart is in a difficult place. Now, I always like to look at some of the major indexes to get a sense of what's going on. So I'm going to start with the S&P 500, and I'm going to, maximize to fit this this screen size. And what I've got here is a busy view that I'm going to come off of, but I wanted to show you one thing in specific. This is a little phoenix, and these two are big phoenixes. So in the last 12 trading days, we have had 3 phoenixes. For those that don't remember, phoenixes are signals of exuberance to the downside that Ian and Ron introduced us to years ago. And we've had a substantial sell-off. Now, the interesting thing here is, now let me clean this up and take away everything but price and volume. And in most cases, there's not going to be any volume. Last week, I put this in as my downside, as one of my downside targets. So I didn't do it this week. And I thought it'd be right around the 200-day moving average. Our S&P 500 has traded down essentially within microseconds of all we needed was 2 more minutes on the market, and we would have hit it. Our closing price is 1906.13. Our 200-day moving average is 1905.22. So we're 90 cents away from our 200-day moving average. I'm concerned that if we break down through that 200-day moving average, we might start to look like the Russell, which is a problem. I've tried to figure out where my next support would be, and I think it's somewhere down here around 1810, which is about 100 S&P points from here. And boy, that's going to hurt a bit, and that's going to take us back to the April lows before this rally went up. So hopefully I'm wrong, but I've definitely changed my tune to bearish. I want to share with you a chart also from my meeting that concerns me and maybe should concern you as well. Then again, I'm not used to being bearish, so what do I know? Here's the S&P 500 of June of 2011, and I should say that's QE2 ends, not QE3, so ignore the 3, that's a 2. Look at how we had sort of a shoulder breakdown at the 50. Look at we are at today. Does it not look like we're setting up to do the same thing on the S&P 500? Now that would mean a bounce here, and we break it another time, and we'll see if we get a bounce. So I'm concerned because there's some similarity here. QE2 ended June 30th. QE3 ends August 30th. This is August 2nd, and we are at risk tomorrow or Monday that we could open up and crash right through. And you could see from the top here in May to the bottom in October, we had 21.6% pullback in this great bull market that we're living in 2011. It took 102 trading days to get to new highs. So I look at this, and then I look at this, and I'm a little nervous. And that is going to temper a lot of my bullish enthusiasm. I look at the NASDAQ. It broke through its 200-day moving average. Okay. Its next support's probably somewhere down here, which is another 6 or 7% away. Maybe it's quite a ways away. I look at the Russell 2000, and I hope this isn't a indication what's to come, because my goodness, the Russell 2000 is that S&P 500 chart. I mean, that's the chart broke down below the 200 up here, and it's quite ugly looking. So and this was my target, and we blew right through my target which we had touched a couple of times. Well, obviously that target didn't hold. And lastly, the Dow, which has been holding up no more, it too broke through an ascending trend line and also through its 200-day moving average. So it's pretty clear to me that we are not under pressure. We are in full correction mode. And the question is, do we bounce here as we have in the past? Okay. Or are we about to enter a much uglier time in the market? I also like to look at volatility, and we have, George Lee is probably licking his chops because he knows that when we fall from here, we're going to have a great buying opportunity. So are we at the peak, or are we going to go back and visit the peaks from 2011 when the market fell back, and 2010, and God forbid we go back to the Black Swan days? Now, it was pointed out by one of my attendees here, there were other events that occurred, credit crisis and others, and right now we have QE going out of the market, but there were downgrades of growth internationally on Friday. So, sometimes I think the market knows in advance. This is a breakout on volatility and something that should be concerning to you if it doesn't turn around quickly. If I look at the dollar has hit my initial target and pulled back. And the dollar was down a little bit on Friday. But the dollar has really had a big move up, and we'll see. Now, my buddy John Person, who's putting out a great program this weekend, he told me I was a little bit too nervous about the dollar, and he thought we're still in a trading range, and he pointed out these highs from 2010 that are quite a ways away. And he may be right, because it looks like the dollar may get turned back at our 2013 highs, but we'll see. Rising dollar means bad for gold, silver, oil stocks, and bad for those stocks with international exposure. Gold and silver were up for the week, but hard to get too excited. Now, the good news is, this has been in for a couple of weeks, gold support at 115, and 115 it held, and gold jumped off of that. This might be a period of time to start accumulating gold, not because it's breaking out and it looks excellent, but because the money is going to go somewhere, and it looks like it may have found support. And you could put your stop a little bit below 115 if you want to play gold. That said, some of the best performing ETFs last week were the 3X contra negative gold stocks. Silver shares don't look nearly as interesting as gold. They've broken through their line of support. So how can you not be nervous when you look at these charts? Now, as you know, I like to go into TradeStation and see if I'm learning anything from my elder charts. And you can guess what you're going to see. Actually, I'm going to show you something we haven't talked about before. First thing I'm going to tell you is that, as we've described before, red is a filter that says you shouldn't be going long. Green says you shouldn't be going short, and blue, it's dealer's choice. So we have red on the daily Russell futures, the weekly Russell futures, and the monthly Russell futures. The Russell futures are weak. Now, the neat thing is we haven't seen these green dots before. We've seen red dots at the top. These are MACD divergence, positive divergences, and it suggests that perhaps we're getting closer to a bottom. How is there a divergence? You have a low here, a lower low, and actually the MACD is less down on the lower low than it was in the prior low, where it should have been deeper. So we've got MACD divergences painting, but we have red charts clear, and we are way down on the Russell 2000. What about the NASDAQ? Lots of red, no divergences, and below the envelope, you certainly expect a bounce soon. But if we're truly entering a bear market, then we may not see it as fast as we like. I look at the Dow Jones. Everything's red as well. I haven't seen this much red on these charts since 2011. I look at the S&P. Here's the NASDAQ futures. and then the S&P. So quick summary on my elder signals, bad. I mean, bearish. So we have no business today searching for stocks to go long. We should be searching for stocks to go short. So that is my initial thoughts on the market. Now, out of order how I normally do it, but what makes more sense is let's go into EdgeRater and let's get a sense of what the market is doing from EdgeRater to see if it can confirm some of the weakness that we're seeing within the HGSI and TradeStation pictures. All right, so the first thing I'm going to do is my bucket analysis, and I don't think anybody likes me anymore because I put on a note and nobody responded. But here is a buckets report, S&P 1500. Let's run it. Sit back, drink a cup of coffee. Just kidding. And you can see our buckets are ugly. 35% of the shares, stocks in the S&P 1500 are trading below the S&P 1500 lower Bollinger Band. So that means 35 on 1500 among friends is probably about 500 stocks, 525 stocks. 84% of the S&P 1500 are trading below the midline. And if I go here, I can look back quickly and see where we've come from. We have been in the red here with lots of stocks trading below for really a month, peaking back here on October 1st. On October 1st, I put a note up on the board, which no one paid attention to, and I showed the buckets. I said, wow, this is a big low. Are we going to turn around here? And I've been saying in my reports the last couple times, I'm not sure the buckets work in a bear market. And I talked about how bad today was compared to the past. And then I posted something ugly, which was how October 1st, 2008, 2 weeks or so after Lehman blew up, how it got worse and worse and worse and worse and worse. So the bad news is we can get a whole lot worse. It doesn't have to bounce. And I think the little chart that I've been using of calling the bounces is done, and that this chart has been mostly related to an uptrend, and that as we go into a bear market correction, I'm going to reevaluate. I have an idea of what the buckets mean, and it doesn't mean the same thing. I like to look at the Hindenburg Omen, and we look at it every week, and we talked about it live here in Palm Beach. And I don't totally understand why we're not getting signals. I don't know if it's because of the ETFs and the option trading and the inclusion of bond funds in the NYSE, but something has changed because you can see on the traditional all NYSE, we do not have a signal. And when I run the NASDAQ, I did get a signal on the 29th, I believe, but I haven't had another signal since. So you've got to have certain things to have a Hindenburg. You need to have new highs and new lows, both greater than 2.2%. The moving average has to be rising. McClellan has to be less than 0. And the new highs have to be less than 2 times the new lows. And what's been missing has been there's no new highs now. Look at the percentage of new highs on the NYSE. 11 new highs, or 0.34%, and 12.22% new lows on the NYSE. That might be a many-month new record for me. Thank goodness. I don't know how far back I can look on this, but because I'm about to run through. So we're going to see that in a second, and you're going to see, I think on the 29th is when I had a Hindi, but I haven't had one since, and frankly, Hindis on non-NYSE indexes don't really mean something. And of course, now I'm not showing it. Oh, wait, it hasn't switched. Switch. Thank you. And there it was, the Hindi on 919. So no Hindenburg should make me feel good, I guess. Not really. Then I look at the market summary. And I use this to get a sense of what's going on in the market, and I've got a new use for it today. So typically I'm looking at this column here, and I know when it's easy to go long is when it's green, and it's tough to go long when it's red, and it's Woody's buy-sell indicator, which is %B times bandwidth. I think I should pay more attention to that little yellow area. So if I go back into my PowerPoint and I go into something that Woody taught us years ago that I never really picked up on. This is about bandwidth. Bandwidth is the width of the Bollinger Bands. And when bandwidth, this is a Woodward slide, used with Ian's permission, hopefully. Bandwidth is narrow when the market is calm. It's wide when the market is in a deep bear. You throw in the towel when it's 0.4. When it breaks above 0.5, it will turn yellow and signal a major correction. And here's where we are today, and this is the first yellow in a long time. That might be evidence that the red that I'm seeing on the Woody signal is not your normal red. And then here is going back to August of 2011, and this is that time when the market sold off in the past. And I'm going to show you a correlation between that and today in one moment. But you can see we went to yellow, brown, and black. I'm going to be watching this because this is not a market that you're going to want to play in to the long side at all. Here is that market. This is QE2, as I mentioned before. And this is the date of that I did that, that it turned yellow the first time, which corresponds a lot with today. So Edge Rater tells me I don't really want to be in. If I run the bear funds, the 2 and 3x bears, I should see green because they are looking nice right now as the market's selling off. And I don't see all green when I run the 3x bulls. So using Edge Rater from a market perspective, it confirms my bearish status. So I'm going to finish my assessment of the market and saying, ugly. I don't want to be playing long right now. And so I'm going to be thinking about what I can be doing to protect myself. Now let's get an idea from an industry rotation of whether or not something is going on good or bad. So I'm going to open up my warehouse view, and it should probably still be in top down. I'm going to go down to 07 in the industry groups, and I'm going to see that I have 177 groups, and I'm going to make sure I'm being ranked by raw combo. And healthcare supplies come to the top. One of the guys sitting here has done very well trading Lakeland, and healthcare supplies are doing well because of Ebola concerns. So I've got 177. Let's look at a 2-day up. That's it on the 2-day force. It's about an all-time low. We've got 4 groups. Now, the all-time low might be because we're getting near a bottom, or it might be because this market is trashed. I'm going to take the latter, not the former. So typically what I would be doing now is I would be right-clicking on Healthcare Supplies Index, changing to Index Group, and I would be looking at the stocks to see if there's anything I want to buy. This is Alpha Tech Pro. Let's take it down to my favorite shot. And as I look at Alpha Tech Pro, I see a stock that broke out. It's way too late to buy. I figure you guys can figure that out already. So let's look at it over the last couple of weeks. So this date here is September 23rd. And I picked this date for a reason. All green above, a mobile breakout from a squeeze, breaking above the moving average on unbalanced volume, and a kahuna. So this could have been a place to buy. We're off the top on the high jump area, It's a cheap stock, less than $3, and it traded 500,000 shares. And if I go back here, you can see it traded 41,000 shares. So this is why I wouldn't play this personally. But let's see what happens if we step forward. So I would have seen this end of day. I would have put a buy stop in probably about 295 above where it closed, and let's see what happened. I have no idea what to expect. Well, fortunately, because of this long tail here, I probably would have gotten filled after it pulled back from the open, and that would have been a time to enter this stock. Didn't close below the prior day. I probably was not shaken out. I'd be out of it there. So, and then, of course, after I got shaken out, the stock ran up further. So this is a cheap stock. It's, when you look at it today, it's way extended. It's run from 3 or from 2.5 to 7.5 in 2 months. Not for my money, and I wouldn't have bought it before anyways. So way extended. Alpha Pro Tech. Becton Dickinson did a buyout, so they bought Care Fusion. CR Bard. I really don't want to find longs, so I'm going to be very picky. Uptrend, pullback to the 50, weekly, breakout here. Not a bad picture, actually. Broke above the 50 with a kahuna, mostly green. I'm very worried about the market. That would be enough to keep me out of it. But if I was building a bounce watch list, this might be one of the stocks that I put on. Just to look at Lakeland, it doesn't come in. LKND? No.
L-A-K-E.
L?
L-A-K-E.
Oh, Lake. This one doesn't show up because of the some of the ranking things. It doesn't make our scan. But if you liked Alpha Pro Tech, then you like Lakeland. It's got the exact same pattern and looks toppy and probably something that you don't want to be in unless it trades up from its recent close. Second group, so that was hit back. So I right-click, hit back. Apparel, footwear, design. Well, there's your Lakeland. Interesting. It's under apparel. The other one's healthcare supplies. I usually don't buy anything that trades below its index, but let's just look at Carter's for the hell of it. And Gildan.
Is that why the index is not at the top of the list?
Yep.
Duh.
So you have the chance to only select those that are outperforming. So in this crappy market that we live in, if the market forces were with me, this is not a bad looking chart. I got a pullback and a bounce off the 50. I wouldn't buy this until I saw momentum coming in, pocket pivot, Bible gap up, person's buy signal, kahuna. But I kind of like the pattern, and this might also go on a potential, if the market turns around, list. Those that perform the best in a downtrend might lead up. Here's Gildan. Again, same story and much more compelling in my book. Pullback to the 200, multiple pocket pivots, multiple kahunas, mobile breakout from the squeeze. If I wasn't so bearish on the market, this would be going on my buy list. So I think that's something to keep in mind. This actually looks quite good. This is Gildan, G-I-L. So even in this bear market, using top-down approach, a couple good things come to the top.
They're both cold, aren't they?
Yeah.
Yeah, so maybe seasonal trades for Christmas.
Yeah, potentially. Utilities, no shocker with the market in deep caca, utilities will come to the top. And I'm not a big fan of utilities. I've got some shooting stars here that I don't like, but what I do like about utilities is I can ride out corrections and make money. Duke pays a 4.1% dividend. Southern Company pays a 4.7%. Shooting stars again, that's interesting. I think they probably sold off because of the whole market. Here's PCG, 4.0% marketing. Dividend. Scana, 4.3% dividend. Xcel Energy, 3.8%. These are stocks that have gone sideways, that have not participated much in the run-up this summer before the correction, and they probably won't participate much in the pullback. They're defensive plays. If you like utilities and you want to make a little bit of return, Utilities look like they're okay. Tobacco I can't buy because I'm a cancer doctor, but if I took away my ethical feelings, these are also big dividend defensive plays, so not a big surprise that they're up here. Yeah, you want to talk about tight, lower left, upper right leader? Does it get any better than this? No. Altria Group, shooting star as the market sold off, 4.5% dividend. Lorillard, pull back to the 50, pocket pivot, kahuna, and a mobile breakout from a squeeze. LO, 4.1% dividend. I wish I could buy tobacco stocks. If I could, I'd be buying that stock potentially on Monday. If I want to park money, you're buying it at free parking, in a squeeze with a mobile breakout at kahuna and a pocket pivot and a 4% dividend. Reynolds American, it's already popped up a little bit, same story, 4.5%. Philip Morris, 4.7% going sideways. So that's the two-day force. Now, embedded in the most recent update of HGSI is functionality to look at a 5-day force. So let's expand out my picture a little bit. And over 5 days, I go to group. Nothing has changed except Reits have added to it as well. And no surprise, because Reits are like utilities with a foundation. They're dividend plays. They're not typically growth stocks. And John Person went long HCN a while ago, and you could see HCN breaking out multiple kahunas or pocket pivots, a kahuna here, everything turning green. It pays a 4.8% dividend. And you could go through the REITs. And again, there's some commonality. There's Ventus, Equity Residential. These things sell off in the setting of rising interest rates. When people think rates are going to stay low, they take off. They take off for two reasons. One, they pay a big dividend. Their dividend is more valuable when interest rates are low. They also borrow lots of money to build construction, and low rates are good for their business. Again, if I'm looking at a pattern, pullback, breaking through the 50 with a pocket pivot, had a kahuna the day before. Yes?
Two quick questions. The light blue compared to the dark blue?
So pocket pivots have 5-day varieties and 10-day varieties. And the dark blue is 10. The light blue is a 5-day. Those are something new that Gil's been using. If you're a 10, you're also a 5, but you get the dark color. Okay. And then on the kahunas, the darker the colors. Excuse me?
There's a maroon color?
That's the Eureka. That's a little Eureka and a big Eureka.
Pocket pivot.
It's odd that you get the
Right
blue
there.
Eureka on the same day.
Those are pocket pivots down.
Right, but you get a pocket pivot up, dark blue.
But remember, the Eureka, great questions, are calculated on the NYSE, not on the individual stock. So that's telling me that the market is soft with 3 Eurekas in a short period of time, but my on-balance volume is rising, multiple pocket pivots in a kahuna breaking out above the 50, the REITs are strong. So it didn't take long to identify where the strength was in the stock market. Let's take a look at where it's not. So I look at forced 2-day down. I have only one, which is kind of interesting because REITs actually flip-flopped on Friday. They had the REITs were down and they had massive volume for the 2 days. So my guess is, and I can only guess, we can look at the REIT index, they probably traded off Friday when the rest of the market, or Thursday when the market was up. Let's see. So the the force index has 2 down days in a row, and the volume on the REIT index is 1.86. I don't know exactly how to explain this. It just tells me why it wasn't on the other 2-day list, that it had weakness from a force index on the last 2 days, but it's been strong over 5. So it pulled back on Thursday and Friday. If I expand it out to 5 days, I see lots of red. So have George build me a 5-day, and you too, force, because I have thought that 2 days is too short of a window. So what's leading the way down? Semiconductors, 13% down over 5 days, 6% 1 day. Do a right click, change to index group. Micron, this was an example of a leader that's now turned to a trouble. So it traded down to its 200-day moving average. It broke through its 50. Everything is red. Pocket pivots to the downside. Kahunas. What I would want to see on this stock, trade up to the 50 and trade down from there would be a shorting candidate. This stock is broken, and it has a lot of healing to do to become a bit bullish again. It also has very slowing earnings per share rate, so not a big surprise. NXP, such a big drop that it set off a bingo. Well, bingos are usually capitulation. I'm probably not interested in shorting a stock. It's capitulating. Intel. Wow. This has been a leader. It got clobbered. Now, I don't want to short the first breakdown. I want to come back and test the 50. I want to short it when it fails that 50. Texas Instruments. All right. So these were leaders. So what's the easy way of playing bad news in technology? 2. SOXS is a 3x direction semiconductors. So and this is bearish. So for every 1% semiconductors go down, this goes up 3% if it actually functions. It's not going to be a full 3%. So if you believe that the semiconductor world is still going to get worse, and maybe it's already too late, these are something that you might consider buying. And you could see if these were stocks right now, we've got downtrend on price, divergence on unbalanced volume. We've got multiple kahunas coming in. Everything is green, and I broke above the 200-day. I have a position in this. Another way to play it is TECS, which is 3x technology bear. So more than just semiconductors, same chart pattern. So you could be considering shorting individuals here or shorting the ETF. Oil exploration. Interesting because sometime soon we're supposed to get to a seasonally strong period for energy stocks, like middle of this month. They got hammered, and they're either getting up to be good buying setups or not. You got bingos galore and Anadarko Pete. The 200, it just knifed through. I mean, your shorting opportunity was when it couldn't get above the 200. It's too late. I have EOG Resources. These are, again, bingos galore. Chesapeake's got a doji there. Maybe you'll get a high close doji this week. These are, to me, are too beat up, but these stocks look like crap. This is a horrible market. Now, if I don't want to take individual shorting risk, I look at ERX, which is long oil energy, and it looks like these stocks. If I think there's a recovery, I might want to look at ERX. If I want to play the short side, I look at ERY, and you see a breakout there. So this is how I play contra ETFs. I can't pick which one I want to short. So I'll short the group. I'll buy the contra ETF. Another way of playing them is to look at DIG, which is long, versus Doug. Whoops. Which is, looks like the same pattern. So I'm being selective on my ETFs and buying contra ETFs because I think it's getting late perhaps to pick which one of these to short. I like to see a rally and a failure. Communications equipment. These are the stocks that were leading. Arista is one that showed up on one of my shortable lists, so we're going to get to Arista and look at it. Cisco, it's already blown through its 200. It's got a bingo. Ditto on Juniper. Ditto on F5. Okay. So here's the puppy that I'm going to look at to potentially short. Now let me tell you what potentially short means on this one. I have a mobile breakdown from a squeeze. My momentum indicators all look red. I had a pocket pivot volume to the downside, and I had 2 kahunas in a row to the downside. My stock has not broken down. So, if this I want to see it rally and fail at that 50. And I'm going to look for it to rally and fail, and then I'm going to consider this to be a potential short because it's not too late. Procera. This is what you want your short to do. Sienna. So how do you pick a winner in this case? Here's another, it's not an expensive stock, so I like to short more expensive stocks. Hard for me to pick stocks that are going to go up from this list. So that was communications equipment. So I have Halliburton. It's one of my biggest positions. And thank God I have 10 more puts than I needed for share coverage bought at the high. And then I sold.
What did you choose to buy your puts?
What?
What did you decide, that candle pattern, when you said you bought them at the high?
Yeah. I bought my puts mostly because I've ridden this puppy down before. And the puts were really cheap. And I had $75 puts. I thought we were going to bounce back here. So I just decided to roll my puts forward, and I sold my 75s and bought 62s, 62 and a half. So I was able to put money in my pocket.
I just meant when you bought them, was it at the point where price broke below the 50?
Right here. So I'm very happy with my puts. But now I should have sold my stock. Okay, because essentially what I've done is I've lost long-term gains and replaced it with short-term gains. On the other hand, if you had to ask me 10 stocks for the next millennium, Halliburton's one of them, and I didn't want to give it up. Stupid. Okay, I can always buy it again. Stupid. But I feel better because I bought the puts. And why did I buy more than my positions? Because you always have slippage and you have a premium to pay. And I guess right, but I end up still losing a little bit in the deal because I had to pay for the premium of the put. By buying the extra puts, if I guessed right, those extra puts will make me not have to worry about, I end up win more than I lose a little bit. So, and Schlumberger, this is an ugly market that we're in. This is hard for me to be bullish. Hard for me to believe I'm so bearish, but I am bearish, goes up the wazoo. Next group down is Internet Media, some of our favorites. So let's talk about the first 5 or 6 or 8. These have been the darlings. So let's find some more things to potentially short. Twitter, PSA reversal, pocket pivot down, kahuna to the downside, mobile breakdown. So it's got 2 areas of support here. All right. I could short the stock right now. I'm not sure I short it right now. It's still very close to its all-time high. I don't have Morales kahunas. I think it breaks down below the 200, tests it, and that's where I want to short it. Because with its 50 and its 200 right underneath, and it was a darling the day before, I'm probably going to hold the day before I short it. Now, I actually own shares with a $50 put coverage on it, so I'm okay if it drops through. I have short-term profits in. I'll probably sell the stock if it knifes through and just ride my put down naked. You can see the group here. So this might be one setting up for a short if the market does poorly. Facebook, you're right. Facebook is a much better short right now, I think, than Twitter. And I'm going to change some of my own personal stuff on Monday if it doesn't quickly get back up. Facebook is broken down below the 50. And it's got all the ugliness, pocket pivot down, kahuna down, everything's red here in a squeeze. Facebook rides down to see the 200. I think that's a high potential. Now, I got to see what the market's going to do, because if the market turns around and is very powerfully positive to the long side, then I don't want to go short this. It's a former leader. It'll be a leader again, but that's ugly. Google coming up for a seasonal trade. One word, ugly. Do I have the balls to short Google? This is the other Google. Let's go to the longer Google, Google L. It shouldn't look any different.
What's the difference between the two?
Different. They split into different types of shares,
Oh, I didn't
and it
know.
may have something to do with voting rights, I think.
Yes.
Okay, but they're both about the same price. So here's Google L. Does that look like a short to you? I agree. Yes. The problem is, its seasonal time to go long is coming up in the next few days. So I'm not sure if I want to short against a stock that out of the last 10 years is probably up 9 times and up big. But boy, kind of like Facebook, it kind of looks like a short. But its seasonality is against it. Let's keep going. Yahoo held up the best of them, and I think Yahoo's held up because of the Alibaba money. Despite the sell-off here, its on-balance volume continues up, which is a bit of a divergence. It's got its 50 underneath. I'm not buying, but I'm not selling. I just don't get Pandora. So, and then LinkedIn, setting up for another short. Wow, isn't this fun? Show you something that's even worse, because I skipped it before because I'm doing this live and I get nervous and jittery, but I'm supposed to look at my special indexes that we use to track the market. And boy, do they look ugly. I looked at them last night and put them in a little PowerPoint that the people here have. More reasons to believe that this is done. We put, crap. Oh, I've got no filter on. We put these indexes together for the sole purpose of the fact that you look at market leaders, and when market leaders sell off, then they hopefully give you an early warning signal before the market sells off. And so I've got 3 groups. The first group was put together in March at the HGSI meeting. So about 45 of us sat there. We picked the leaders at its time. And this list has been long in the tooth. And it took until here for it to die. And this is what I look for in the stocks. Break below the 50. Test, 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 fail. That's when I want to short. And then it held for a couple days. This might have shaken me out here, held it and bounced. I'd short this if it was a stock. Our LLUR list for March will no longer be followed because it is tot, which is German for dead. Our canaries, you want to see what dead looks like? Oy. Our canaries look a lot like some of those high-flying internet stocks, which they are, on its way down to the 200. We'll see if it bounces. So the canaries are dead. The LLUR list,
This index is only working the trending market.
No, these indexes are designed to show you when we do the index, we pick the best of the best with the hypothesis that when the market rolls over, the leaders fall first and hardest. And we want to see when the leaders fall, these were leaders, to give us a clue that the market's going to follow over. And we'll actually, as a group, do our own little loser index before we go home tonight. And I have no idea if a loser index is meaningful, but I bet if we put some of those stocks that we just said were shortable and we track them, then we might get an idea of when the market's going to turn around. So here's the LLUR Florida list. So this was done in June. Dead. All right, dead. They did their job, okay? Their job was to get you out of the market before you got too hurt. You should have gotten out of the market. This is when I started shorting stuff, and others did 9:30. It gave you 10 days. We've been down 15 days. So what we've done thus far is we've talked about the market being tough and looking bearish. I showed you some evidence that perhaps the QE2, QE3 correlation might be working. We looked at industry rotation, very few winners except for defensive dividend players like utilities, like tobacco, like Reits, and some apparel stocks which might be getting ready to go up because of Christmas. We looked at our buckets and coming up with the idea that perhaps in a bearish market, buckets will get worse over time, which they are doing. And we talked about the bandwidth. So I'm going to cut the tape now and then just finish up with my group here. So all I can say is it's a tough week. Hopefully we'll see a bounce on Monday and not, well, actually I hope we open up 500 points down if you want to know the truth, because I want to be done with this bear market correction. But my guess is we got more pain to go, and I can't forget what those indexes looked like on Friday. They just were straight down in the afternoon. So everybody have a great week, and sorry this is a little bit abbreviated, but we'll see you next time.